being recorded as usual so that the others also benefit from this. So elections. So prior to national elections, the existing government says that if elected again, it wants to focus on delivering the following. So we need to work out what policies the government needs to implement in order to achieve the objectives, deliver these objectives. There are 2 or 3 types of policy that we studied: fiscal policy, monetary policy, and supply side policy. Yes, let's start with A reduction in child poverty. So you tend to see quite often the government talks about reducing child poverty as a policy. Child poverty. So what can the government do to reduce child poverty?
Increase it's like a subsidy, not really a subsidy, but like food vouchers.
Exactly, benefits. Child benefits. So that's fiscal policy. Transfer of money from government to the parents. You may have had child benefits. Everyone in this UK is entitled to have child benefits until they are 18. Yeah, so free dental checkups, free NHS, this is all child benefit. So that's the reduction of child poverty. In other countries, these are money, children pay for these services. So poverty is high as a result there. Children are poorly, and they are poorly clothed, they're hungry most of the time because it's expensive. But in this country, you get paid, parents get paid a certain amount of cash so that they could feed their children. But there are parents who could actually feed themselves for the money instead. So child poverty may or may not work very well. But that's what the answer is here. Yeah, fiscal policy through payments as to parents from government. B, improvements in productivity in manufacturing industries. How would a government improve productivity in manufacturing? Manufacturing has shifted to East Asia, to China especially, yeah? And a lot of people are not talking about, especially Tory government, Trump is talking about bringing the jobs back to the USA, back to the UK, for example, yeah? What can they do?
This is monetary policy, right?
This is supply side policy, yeah, supply side, because you want to improve the productivity through training. If you train your workers, they will produce more per hour. Yeah, per hour. That's the productivity, measure of productivity. Yeah, productivity is production of output within a given increase in production per, let's say, per hour or per week or something like that. Measured as a relative, in a relative sense. So it's a supply side policy. So we need to legislate the labor market, make it flexible for people to switch the jobs, and maybe raise the minimum wage in some way such that it incentivizes the people to work harder, educate them in the long run so that they're much more educated. When you have educated workforce, you have workaholic workforce. Yeah, uneducated ones you usually will be less incentivized to work. So government spending has to be increased as well. It could also involve some sort of fiscal policy here, but largely it's a supply side policy. Now C, increase in investment by businesses. So how would the government induce an investment increase, private investment increase? How would, if you are a government, let's say you are a Boris Johnson guy, how would you make the firms spend more on invest in new technology? How would you incentivize them?
Threaten.
Threaten. Well, this is a democracy, so that doesn't probably work. Maybe he's going to leave the job. What can you do? Your future managers, maybe some of you will end up being a government employee. No, you don't want to? They pay well, 40,000.
Unethical people.
Unethical people, okay.
Monetary policy.
You can use monetary policy, that's correct, yeah. You can reduce the interest rates, right? You can reduce the interest rates. What does it mean? It's cheap money. Companies borrow. When the interest rates are lower, companies borrow. More money will be borrowed, more will be invested as a result, so it's a monetary policy. D, a reduction in the rate of inflation. How would you reduce the rate of inflation if it's increasing? what needs to be done? Some of the money needs to be removed from the market, right?
You increase interest rates.
Exactly. Increasing the interest rates means less demand for money, less demand for loans. As a result, less economic activity, which induces what you call, not induce, it reduces the economic activity basically. Investment will curtail as a result because high interest rate means expensive loans and businesses do not borrow as much. Right? So that's it. Now E, last one, a reduction in government budget deficit, which is this was also a quiz topic. Government policy, government budget deficit. You know, when businesses make money, when they take in some revenue, what happens is that they remove or extract or subtract, I should say, expenses. The difference is profit. But for a government, the difference is either a surplus or a deficit. They don't make losses. The government doesn't make losses because it's a public non-private business, basically. Government is not a business, but it's a non-private organization. So what they do is they collect revenue through taxes, and they spend on projects. That's called expenditure. The difference between tax revenue and government expenditure is either deficit or surplus or a balance equal to zero. So in the case of deficit, taxes are lower than spending. What do they need to do to plug that gap, to remove deficit or reduce it? Increase taxes, so that tax revenue is higher, or cut spending. Okay. Question number 2. If you do not have any question, please. No questions? Right, question number 2 now. Explain how each of the following developments would affect the supply of money, the demand for money, and the interest rate. Illustrate your answers with diagram. So the A, first one. The central bank's bond traders buy bonds in open market operations. Do you understand what it is? What that statement means?
I don't understand what the statement means.
Bonds, Bonds. Bonds, what are the bonds? You know, if this is a company, let's say this is a company, this is a firm. If they want to raise cash or funds for, let's say, a project, what are the options for them? They can go to the banks, right? And they could borrow loan, or they can go to financial market, City of London, and issue bonds. Bonds are promissory notes. Long-term bonds usually maybe 20-30 years. Short-term are usually up to a year. Medium-term between 1 and 5 years. Now the bonds issued are basically securities. They are sold usually directly to investors, or banks can also be investors. So investors in return pay, say, 1 billion to this firm. So when investors purchase a bond, the bond says, you're lending us 1 billion and we will pay you 7% annually interest.
So bonds like a loan from
Exactly. It's a kind of a loan, but from investors, and investor could be anyone. Makes sense, guys? Investor can be an individual, an institutional investor. It can also be a bank, part of institutional investors. Makes sense now? Now government also trades bonds. They can trade treasury bills, government bonds. Government bonds are traded to raise money for the government projects. Treat government as a company in this case, although it's not for profit purposes. It raises money for building NHS, roads, bridges, new parks, and things like this. Makes sense, guys? Now let's go back now. So what happens to the money market now when central banks, bond traders buy bonds in open market operations. If they buy bonds,
You're investing in the company.
buying bonds, not.
Oh, but there's a
Yeah, it's kind of investing in companies, isn't it?
They're giving them money.
Yeah, they're giving out the money, yes. So when they buy the bonds, they are taking this promissory notes back in return for money. Yeah. So what happens in the money market? So this is the quantity of money. This is interest rate. This is our money supply. Yeah, this is our money supply. Remember, money supply is always vertical. Once the government supplies the money, it doesn't touch it, it doesn't remove it, it doesn't withdraw it from circulation until after some sort of monetary policy is enacted. So in this case, buying bonds means supplying the market with cash. So that shifts, the supply curve shifts to the right. So this is 1, this will be money supply 2, or quantity of money basically increases, yeah. And remember, the demand for money is downward sloping demand curve, so money demand stays the same. What happens is that originally this was the interest rate 1, then interest rate, because of supply shift, declines, and demand for quantity demanded also increases as a result, yeah. So quantity demand increasing in the market reduces the interest rate, yeah, down. So if it was originally 7%, now it's 5% because there is too much money. It's like the price of apples go down when the supply increases, yeah? Apples here is the money, basically.
So the money is not worth as much.
Exactly. It's increasing inflation as well in the end, yeah. In the end, it will increase inflation as well, yeah.
QM is quantity of money.
Quantity, yes. QM, it's quantity, yeah. If you want Q, it's quantity of money. Supply of money, yeah. QM is Queen Mary as well.
Yes.
Use confusing. Right. B. An increase, guys. An increase in credit card availability reduces the cash people hold.
A decrease in demand.
Decrease in demand for money, isn't it? Because when you have credit card to spend on, you don't need cash, right? You spend the money. Your spending is due to credit card applications. Your increase in credit. So as a result, demand for money decreases. Supply didn't change. It's still the same supply. So demand shifts downward. So let's describe that on a graph here, yeah? So if I can clear this, how can I clear this? Right, that's better. So quantity of money, interest rate, this is our supply, money supply. Is some sort of quantity 1. This was our original demand curve. But because of alternative spending options, credit cards, our demand for money will now decrease. As a result, because demand for money is decreasing, the interest rate goes down. Not much is demanded, so price of money goes down as a result, yeah? Right, next, central bank reduces banks' reserve requirements. Can anyone explain what reserve requirements are? Or the concept of reserve requirement?
Does it mean that the bank can use more money for like their loans?
Exactly. Right. So to explain it in more details, think of it this way. This is your bank. This is bank HSBC. And currently the reserve requirement is 20%. Reserve requirement is 20%. Which means then if you put into the bank £100 deposit, the bank then withholds 20% of it, £20 of it, and gives away £80 as a loan. Understood, guys? Gives out 20% or 80% of that deposit, or £80 as a loan. Now, let's say now that the reserve requirement now is 10%, which declined. That means from every £100 investment, HSBC now withholds only £10. keeps it in the central bank reserve account, then gives out 90 now. You see, money supply now increased by 10 pounds now in circulation, which means then shift in money supply to the right. Yeah, money supply shift to the right because of that operation. So more money will be circulated in the economy now as a result.
Wait,
Now,
so this money supply is for the, like, is the bank's money supply curve, right? It shifts to the right
no, it's in the economy.
in the economy.
Bank basically loans extra money into the to the businesses. The businesses spend it in the open.
So the banks are the ones supplying the money to the
Yeah, the supplier is central bank, the government. However, government tells the banks to keep some of them, and if that requirement is lowered, then more will be in the circulation, in the hands of the people. Yeah. Banks are the intermediary basically. You see what they did? They took out your took in your £100 and give out only 80 initially. Then reserve requirement declined, then they give out 10 more pounds. So the supply in the circulation increased as a result. Right. D. An increase in oil price shifts the short run aggregate supply curve to the left.
Wait, sorry, I have one more question. So for C, right, when money supply shifts to the right, will interest rate decrease as well?
Oh, thank you. We didn't talk about that, did we? Oh, sorry. I'm trying to be quick given the time that we have. So yes, indeed. So interest rate obviously from R1 to R2 declines. Yeah, it declines. Luckily, I'm not taking this test. If I were to take the test, then half of the answer would be eaten up.
Yes.
I wouldn't be answering all of it, apparently. So, D, guys, an increase in oil price shifts the short-run aggregate supply curve to the left. Now, what it does is that when oil supply is curtailed, the price will go up usually of oil. And remember, oil is an important input into the production. So that actually shifts the aggregate demand to the left. What happens when the aggregate demand shifts to the left?
Aggregate demand, supply.
Sorry, did I say demand? Aggregate supply shifts to the left. Yeah. Let me draw it. It will be much more clearer. Let's draw that process. So this is the RGDP, real GDP. This is the price level, guys. This is the. Then you have this aggregate supply, aggregate demand, and aggregate demand shifts to the left. Aggregate supply shifts to the left. What happened? Notice this, what happened. From the equilibrium point at the price level 1, the price level increased to price level 2. So the price has increased. When the price increases, we have demand for more money. So this is now money supply or quantity of money against interest rate as before. Yeah. Now remember, we didn't see any change in money supply, but demand. So this is our money demand, but demand increases now because of price increases. When the prices increase, demand shifts upward. So this is our new money demand, and that causes the interest rate to go up. So that's an increase in interest rate. Yeah. All right. So moving on now. If you don't have any questions, number 4. Oh, we're doing number 3. So number 3 now. Suppose economists observe that an increase in government spending of 10 billion raises the total demand for goods and services by 30 billions. Right. Okay. And if these economists ignore the possibility of crowding out, what would they estimate the marginal propensity to consume to be? So MPC, marginal propensity to consume. Do you remember the definition of marginal propensity to consume? This is an important topic, guys. This is an exam topic, so make sure you review it properly. So marginal propensity to consume is basically change in consumption when our income changes by a pound. And we know that when the injection was 10 billion, when the government, so change in G was 10 billion, aggregate demand, change in income went up by 30 billion, yeah? That one, let me just have a quick look at my notes if that's the case. The numbers I have. Yeah, government spending increased and total demand, which is also an income in this case, increased by 30 billion. Now, we can work out, given this detail, we can work out the multiplier effect here. Multiplier is basically 30 equals 10 times K. The K is the multiplier. It tells us by how much our GDP increased or total aggregate demand increased when we injected £1 into the economy. It's by how much our income multiplied when a pound was invested into the economy. Now, using this, we can work out the K. K is basically 3. Makes sense? And there's another way of calculating this K. That is K equals 1 over 1 minus MPC. Now, I know the K, I can work out what the MPC is, eh? So MPC here is, what is, how do you work this out?
0.
Divide both sides by 1 minus, multiply both sides by 1 minus MPC. Yeah?
1/3, right?
It's around 1/3. So that's K, let's work it out. 1 minus MPC equals 1. From there, I need to sort of isolate MPC. So K minus K times MPC, 1. And from there, that's K times MPC, 1 minus K. Then MPC is K minus 1 over K, which is basically 1 minus 1 over K. Makes sense?
So it's just 2 over 3.
Then if you work this out, MPC is equal to 1 minus 1 over, was it 3?
Yeah.
So 2/3. What does that mean? It means we consume 2/3 of the income that we received. 2/3 of the income we received. Guys, are you with us?
Yeah, kind of.
Kind of. So that means you aren't going to take this microeconomics for managers next year.
Oh, no.
I saw the exams today for this year's students. They're quite...
Our exams.
No, not yours, the microeconomics one.
Yeah.
I moderated them basically
The
and
next semester.
verified them. They next year's basically. If you're taking it next semester, next year,
Can I retake? Can you give me the thing now?
no, that won't help because the guy will have to prepare another exam. You're going to be second year next year. So I saw this year's in microeconomics for managers exam, and they are quite interesting. I like this. It's easier as well. They're much more. All of them are essays. So if you plan to take economics course, then that's a good course, good module.
What would you recommend us to take? Drop out.
Drop out, yeah, altogether, yeah. Right. I would recommend to take economics because at some point you will be working for a business. You need to be a confident economics thinkers or think like
If
economists.
you wanted to go towards the banking route,
That's definitely economics. Banking is economics and finance, and you need to learn the tools that monetary policy, fiscal policy, bankers usually think of them.
Because there's a insight week at Barclays. You know, insight.
Okay, that's good.
And yeah, I've applied to a few of them, so I just want to know what route.
Economics. Choose economics, and your if you're working for investment bank, the pay is really high. The pay is really high. You may get 50,000 a year as a starter, but your bonus could be 100,000.
Yeah, but the hours are long.
That's fine. 100,000, you just exit it and invest that 100,000 elsewhere and make money. You know, some people earn 100,000 a year, but their bonuses are millions.
And I'm both conservative, I don't get taxed.
So you pay tax, of course, but then you have still thousands, hundreds of thousands there in your bank account, which can be spent elsewhere. If
You could do it.
me,
Just give us free money, man.
Why? You're an economist.
yeah, but I am a lecturer. I like teaching than making more money because when you make money, you also make lots of mistakes.
Oh.
It's much more. There's other side of the story for me. Right. So B now, guys. B. Now, suppose the economists allow for crowding out. Would their new estimates of the MPC be larger or smaller than their initial one? Right.
Smaller.
It will be smaller, won't it? If there's a crowding out. The reason is. Let's look at the crowding out. What happens is that when the economy, this is the quantity GDP, RGDP, this is price level, this is our aggregate supply, this is our aggregate demand. When there is an injection into the economy of 10 billion, aggregate demand shifts to this point. That increases the price level from P1 to P2. But this injection creates more consumption in the economy, right? It's an income of someone else, which then will be spent elsewhere. So that shifts the aggregate demand further. So aggregate demand keeps shifting towards the rightward, yeah? To the right, until the effects wear out. So
why does it keep shifting to the right again?
because 10 billion injection into the economy in the form of government spending will become an income for some people. They will then withhold some of it but spend some of it. That income then, the spending then becomes income of some other people, right? So if I get way higher wages today, I spend more money at Tesco. Tesco then pays more salaries, more wages then become expenditure elsewhere, and someone's expenditure is someone's income, right? So this knock-on effect creates more spending in the economy. Makes sense, guys? Remember aggregate demand, AG is equal to C plus I plus G plus NX, yeah? If initially G increases, then it leads to increase in C, that increases I. So there's this knock-on effect, this chain reaction. However, notice what happens now. Because the price is going up, creeping upwards as the aggregate demand curve shifts to the right, the money market is affected here. So this is money demand, this is money supply. Demand for money increase now. Because the economy is doing well, we want more money to buy more.
But didn't the government already spend 10 billion? How can the demand for money increase when you have more money?
People tend to consume more when there is more income. And remember, price levels are increasing.
So
When the price levels increase, there is demand for more money. Because you want to spend more, to buy the bread now, bread is let's say 20p more than last time. So you need 20p more, you carve out more.
But you said the income increased as well because of the government.
Income increases in the economy as a whole, not the person who spent it. I spend it, it's gone now. Someone will receive now more income. And they will spend. From their spending, someone else receive more income. But now, because I spend more, now everyone else spending subsequently, the prices creep up. When the prices creep up, interest rate goes up because there will be need for more demand. There will be demand for money. Makes sense? This is a psychological effect. Think of it this way. Once you get used to spending more, you demand more money.
So when spending increases, prices will also increase.
Exactly.
Then that results for demand
Higher,
for money.
yeah, demand for money increases. That leads to higher interest rates. Yeah, when there is demand for money, what happens? Banks increase the interest rates. They would like more money for their loans. In other words, they increase the cost of. I lost my cursor, so it's here. cost of borrowing. So cost of borrowing is basically price of loans. Yeah, that is interest rate. So interest rates go up. Now when the interest rates go up, it's not the end of the story, guys. When the interest rates go up, what happens is that the demand for loans now slow down.
Decreases.
Yes, investors now don't borrow. Firms don't borrow to invest. That leads to the reduction of the aggregate demand now. So some of the joy here will be disappearing now soon. So this finally aggregate demand settles right here, right? But then it shifts backwards eventually. So this is called crowding out. High interest rates crowd out private businesses. So government spending causes sometimes crowding out. So with the fiscal policy, governments need to implement monetary policy as well to keep the interest rates down by supplying more money maybe. Yeah? If they supplied more money, what would happen? The money supply curve would have shifted to X2 from X1. This would have kept the interest rate right here, lower interest rate. Ooh, it's gone. So because of this, our MPC will eventually decline. We are sorry, crashing last time you were here. We're gone. It's all gone. It's all gone. I lost it.
No, it's okay. You're saying that.
Yeah. All right. So next, then we go move on to the next one. Number 4.
Oh, wait, because AD shifts back, how does that affect MPC?
It will decline.
Decline.
Yeah, we will save more now because interest rates are high. Yeah, we can save and get more money. But that actually causes the spending to go down as well by the businesses, remember?
Wait, so when banks increase interest rates of a loan, their own savings accounts interest rates will increase as well? Is that what you're saying? You said they save more.
When the interest rates are higher now, individuals start saving more.
Oh, they don't want to borrow.
They've stopped borrowing.
Oh.
When you borrow, you invest the money into the business, right?
Yeah.
But instead you now prefer saving because you get more return from high interest rates.
Well, so when you save money in the bank, the interest rate also corresponds to it relates to the ones that get.
Eventually, it leads to lower interest rates. Yeah, that goes back to a spiral effect now. Does it make sense to you? When interest rates are higher,
Yeah.
individuals now start saving more, spending less. MPC goes down as a result. Marginal propensity to consume goes down.
Yeah.
Initially, if they were spending 70% of their income, they may spend now 60% because now saving is more attractive than before.
Yeah.
But at the same time, on the business side, businesses will not borrow because interest rates are high. But because people start saving, banks then reduce the interest rate. So that's the next round of effects.
Got it.
Makes sense? So it's a complicated story, but in fact it's easy one if you trace the story. Right? Right. Question number 4 now. We only have 12 minutes, unfortunately. I really wanted to finish question 5 because that is an exam question.
Let
As
me
well.
go through questions.
Question 4. We can go to question 5 if you want quickly. Yeah, because that's
Yeah.
question 4 is easy. It's a calculation of MPC again. But I'll give you the solutions. So let's read this. So this table actually, table shows the elements of national income accounts of a country. The economy is in equilibrium. Assume that tax revenues are 4 billion. Right, so this is something we've done last week. And consumption here is total. That includes domestically made products and imported products. Yeah. Investment is 5 billion. Government expenses 8 billion. Imports are 8 billion. Exports are 9 billion. Now, you will help me with this, guys. So, do we need anything from above? Nothing, yeah? That's it. Tell me what is a national income in this case. What is it equal to? Aggregate demand, national income, GDP is equal to?
C plus I.
Exactly. C plus I plus G plus X minus inputs.
Wait, so national income, GDP, and AD all the same formula?
Yeah. So all these things then is 40 plus 5 plus 8 plus 8. Oh no. No. That's 9. 9 minus 8. So 8's cancel out. What happened? 8's cancel out.
54.
Exactly, yeah, 54 now. Thank you. So GDP is 54, national income is 54. Now B, what's the value of injections? Tell me please the formula for injections. Circular flow of economy. Do you remember? Circular flow of economy.
Is it just the government expenditure plus?
Yeah, G plus investment plus
imports.
exports. Yeah, imports is withdrawal, isn't it? When you importing, you are actually paying another country, so money goes out.
Yeah.
Injection is when money comes into the economy. Yeah. Exports. So by exporting, we are bringing some cash into the economy. Governments inject money into the economy. Investors inject money into. So I, G are included there. And withdrawals. What are the withdrawals? Just as a recap, what was it?
C plus.
No.
Oh, just 80 minus that.
What was it? How do you withdraw the cash from the economy? By saving, yeah? Yeah, money will stay in the bank. Plus, what else can you do to stop money going into the economy?
Tax.
Tax, exactly. And lastly, you just mentioned something earlier. Imports, yeah? So M. Imports, yeah? Keep this in mind. This is in the exam, yeah? Right, so let's calculate now J, because it asks for J. What is J is equal to?
8 plus 5 plus 9.
Thank you. 8 plus 5 plus 9 equals 22, yeah? 22, thank you. Now C. C, assume the national income rises to, so Y2, which is our national income, 70 billion, and the consumption domestically produced, yeah? CD is, so this is CD2, is 44. What is the value of marginal propensity to consume? And remember the formula for marginal propensity to consume? MPC is equal to change in consumption over change in income. Write this down, please. Change in consumption over change in income. Now, to calculate change in consumption, I need to calculate the original consumption, which is consumption total minus the imports. Makes sense? Because this is total consumption, which includes the domestically made goods plus imported goods consumption. So take away imports from 40. So Y1 and CD2, 1. So CD1, domestically made goods, is basically 40 minus 8, which is 32. And our original income was 54. That's it. Now we just plug in this number into the formula here, this one, yeah? So MPC of domestically made products is change in consumption over change in income, which is basically new income minus old income. Oh, no. It's the consumption I said, but putting the income. Shame that it doesn't, I don't have the eraser here. So that's equal to 44 minus 32 over 70 minus 54, which is basically 16 over
12.
Is it no, this is 12, isn't it?
Yeah,
16. I'm looking at the bottom and then thinking I'm in the denominator and thinking, and right, so that gives us 3/4. So marginal propensity to consume is 3/4, which is what does it mean? What does this imply, guys?
No idea.
If our income increased by £1, we spend 75% of it, yeah? Right. So because the guys are fixated to their mobile phones, It's you're not moving at all, yeah. So some of you. So the sensors didn't detect you. Sorry, sensor here. There is a sensor here that did.
Invisible right now.
Yeah, you are basically invisible by looking at your mobile phone. Yeah. So calculate the value of spending multiplier now.
Wait, sorry, when £1 of
So £1 increase in income will lead to consumption to increase by 75 pence.
Okay.
3/4 of the income is spent. Yeah. Now the multiplier. What was the multiplier? Can you give me the equation for multiplier, please?
MPC equals to K. No, I'm wrong.
Yeah, it's the multiplier we're looking at. D. What's the multiplier value? So that's 1 over 1 minus 3/4, which is by how much will the income increase if the spending goes up by
4. Oh, 4?
4, isn't it? That's it. Income increased by 4 times. So if government injects 10 billion into the economy, the national income goes up by 4 ultimately. Make sense now? It's a little difficult in terms of calculation, and it's calculation intensive thing. But if you practice a little bit, I'm sure you can do it. If you don't have any questions, we call it a day. And please, can I ask